Silver is moving, fast. And for the first time in years, it doesn't look like a random spike. Something underneath the surface has changed. Most people still think of silver as the cheaper gold. But in 2026, silver isn't just a shiny metal. It's becoming one of the most important ingredients in the modern economy. Unlike gold, silver is a workhorse metal. It quietly sits inside the technology we use every single day. Silver is essential for solar panels, electric vehicles, smartphones, laptops, 5G towers, semiconductors, and the hardware that powers AI. It's one of the best electrical conductors on the planet, which makes it critical for solar cells and modern electronics. And electric vehicles use far more silver than traditional petrol cars, sometimes tens of grams per vehicle. Every time the world adds more solar, more EVs, more servers, and more chips, it quietly adds more demand for silver. Now here's the problem. Demand is rising faster than new supply. Most silver isn't mined directly. Around 2/3 of global silver comes as a byproduct when mining copper, lead, zinc, or gold. So even if silver prices rise, miners can't simply flip a switch and double silver output. Meanwhile, ore grades are falling, new mines take years to build, and environmental rules slow everything down. The silver market has been in a multi-year deficit, using more silver each year than we produce. More demand, tight supply, and a long-running deficit. That's a powerful recipe for long-term price pressure. Central banks mostly buy gold, not silver. So why does that matter? Because when central banks accumulate gold, it sends one message: we don't fully trust paper money. That sentiment often spills over into all precious metals, and historically, silver tends to follow gold, just with bigger swings. When people worry about inflation or weaker currencies, they look for real assets, and silver has a dual personality. It behaves like an industrial metal when factories and technology demand are strong, and like a precious metal when people are nervous about money. Silver is both a metal for factories and a metal for fear. Here's a simple tool even beginners can use: the silver-to-gold ratio. This ratio shows how many ounces of silver it takes to buy 1 ounce of gold. When the ratio gets very high, above 80 or 90, silver often looks undervalued relative to gold. History shows that when the gap gets too wide, silver doesn't stay undervalued forever. So what happens next? You don't need a complicated forecast. Just think in 3 scenarios. In the base case, silver climbs steadily as industrial demand grows and supply struggles to keep up. In the bull case, clean energy and electrification accelerate faster than expected, pushing silver sharply higher. In the bear case, a slowdown reduces factory demand, and silver may fall or go sideways for a while. But if the long-term story stays intact, those dips can become opportunities. Silver is volatile. Short-term pain is possible, even inside a longer-term uptrend. And here's what every viewer should understand. Silver is not just a poor man's gold. It's a critical industrial metal for the energy transition and the digital economy. Solar panels, electric vehicles, data centers, 5G networks, semiconductors, they all quietly depend on silver. The world is asking for more silver every year, while supply continues to lag behind. Whether you ever buy a single ounce or not, understanding silver means understanding where the world is going, because silver now sits at the center of that transition. This is Capital View Explained. Subscribe if you want more data-driven breakdowns of the forces shaping your financial future.